You're a Stacey Burke style trader that is struggling a bit with the discretion of his system, often seeing price going the other way. Then this might be for you. We developed an addition to his approach that looks at the bias across different time frames, taking sure that you are on the right side of momentum and trading with the trend. So stay tuned. This is not financial advice. It's only for educational purposes to better understand Stacey Burke Style's approach. Um, so, what is the multi-time frame bias approach? We all trade the classic Stacey Burke signals like first green day, first red day, inside days, 3 days of shorts and longs. We are looking at this especially on the daily setups, so 3 day setups, but also on the week. But often we see these signals failing, like first red days failing often. Inside days, you don't know really in which direction you should take it. Is it a blow off or a reversal? And 3 days of shorts also very often just go on and blow further up. So if this happens to you, then this might be exactly something that helps you, because we developed an approach that looks at the bias of different time frames. So looking at breakouts, fake outs, inside days, and determines across different time frames the overall bias. So this is aimed at identifying and trading with the trend and with momentum. And once you really experience the difference, if you're really trading with the trend and are on the right side of the trend, trading is a completely different experience, because you just lock in your stop loss and take profit, and you watch it, and it just blows all the way to the other side of the range and hits your take profit. It's an amazing experience. So this approach um, looks at alignment of these different time frames. And the good thing is it's fully aligned and integrated with SB style trading. Um, so we're really looking at the Stacey Burke signals, but use them more as a, let's say, confluence. And the real trades we are looking at are completely determined by the bias of the time frames. You will see this in a minute. And this is a very mechanical system, which is very good, especially for upcoming traders, because you can trade it very mechanically, and impulsive trading is brought to a minimum. So let's look at what the bias and multi-time frame bias is and how it's determined. So we're always looking at the three things that markets do, as Stacy always says over and over again. So markets break out and continue, they break out and reverse, or they stay inside and range. He's looking at that as well, and he intuitively also does this across time frames, but he doesn't do it in a very structured and mechanical way. And sometimes price just blows on up, for example. And then he afterwards said, oh, of course, other time frames traders were driving this move. But how did he find out? So how we find this out is we are always looking at the previous high and low, as Stacy also does. We're looking, is price in breakout? So price breaks out. And as long as we are in breakout of a time frame, let's say day here, for example, we are bullish above this breakout level, because the market doesn't tell us otherwise. So this is strength. We have breakout traders driving the move. And as long as we are in breakout, these guys are in profit. And overall, the breakout momentum of the market drives price further. So as long as we don't lose this level, we stay bullish. Once we lose this level, it comes back in. We have a fake out high in this case. So this is bearish. So we're losing this level. We are bearish below this level. It's a sign of weakness, of course. And as long as we stay below this level, we are bearish and are not looking for longs, for example. Then maybe price didn't break out. It's just stayed inside. So this is neutral for the moment and takes over the bias of the last candle. So if this was a breakout and we now stay inside, it's still bullish. So if we have an inside day, for example, that comes out of a fake out low, we have a stronger bias to the long side. And we might look for a fake out low reversal inside day trade, or an inside day breakout long from this situation. The same on the downside. So if we have a breakdown, we are bearish. If it comes back up again, we have a fake out low. And again, the breakdown level here is the critical one. We are bullish above the breakdown level because it's a fake out low then, and we are bearish as long as it stays below. This is exactly also how Stacy looks at it. For example, a low hanging fruit trade, you are in a breakdown and you only look for a sell high in the range of the breakdown level. So it's one of his classic setups, for example. So how do we now bring in the Stacy Burke signals? So Stacy Burke signals, as I said, are then more confluence. So if you are in breakouts, you're bullish above the breakout level, but maybe if you have already 3 breakouts in a row, you are looking at it as an overextended market. So you might not take another breakout trade after 3 consecutive breakouts, for example, or you are very careful with that. At the same time, if you get a first red day, maybe that's still in breakout, then you're also careful with longing, because this indicates that you have longs trapped at the top. And you might also be careful with the breakout. So you might wait for the breakout level to be lost, that you get a fake out high, and then you take the fake out continuation to the bottom. Then, of course, inside days and day zeros, coiling signals from Stacy Burke. It's also something we keep in mind, of course. So once we have an inside day with a certain bias, as I said before, then you look at the bias of the day before, and then you're looking for a parabolic move from out of this inside day with typically a 1 full extension. Then, of course, on the lower side, it's the same thing. If we get breakdowns after 3 days of short breakdowns, we consider the market overextended and are careful with further shorts, and rather waiting for longs. But we don't do this as long as we are trading below the breakdown level. The only case we are doing that is if it's like 3 sessions of drop and also overextended on the day. Then we might even consider a long at the very bottom. This is how the two systems come together. So we all start looking at the bias across timeframes. I will show you in a minute how we determine our setups from that. And then we look at the Stacy Burke signals in parallel, and especially look if it's overextended or if it shows signs of reversal or coiling. So how does this now work? How we track the trend across the different time frames. And as you have seen, we have our indicator doing that. I will do a video on this shortly, but I thought I'd first explain the approach better, then it makes more sense to explain the indicator. So here, for example, in a downtrend, like similar to what oil did like over the last 2 or 3 weeks, maybe coming out of a fake out high, previous month high here, doing a fake out, previous week's high, breakdown, for example, so bearish on the higher time frames, coming down in a daily breakdown. You see here then this is the bias across the different time frames, day, week, and month. Then here you might have a breakdown on the day, breakdown on the week, fake out high on the month. So you're very bearish, but you're very deep down low with the 3 days of shorts potentially. And then once it comes up here again with a fake out low. So here you could make a reversal trade. It's not a very high probability trade. It's only a 1 star, maybe 2 star for me. But this is the first option in such a cycle to take a long trade. Then you have a fake out low here, a daily breakout. The next trade here could be a breakout continuation. It's still only a 1 star because you have higher time frames bearish. So you're rather waiting for the reversal into the downtrend. So this is the overall logic of this approach, that once you have a higher time frame downtrend, you're waiting for the pullback, and then you're trading the reversal of the pullback back into the higher time frame downtrend. That's the sweet spot trade you're looking for. So you might get a first red day here then, out of some breakouts. Maybe it's even 3 days of breakouts into this higher time frame downtrend. Then you get a fake out high here, making it bearish. And then you have here your 3-star setup. Higher time frames bearish. You see it down here. Lower time frame breakdown, fake out high inside. And then you're looking for our entry signal, an 8H fake out high, for example, as entry confirmation. And then you can look for a real measured move here with a big trade to the downside. So you see here down the colors and the signals. So you're always tracking the bias across the different time frames and see where it aligns. So if you have like different colors here, you have to be careful a bit and judge the overall context, and it's only 1 or 2-star trades. Once everything is aligning, and maybe even the Stacey Burke signals aligning, like here this first red day, then you have a real all-in trade and go into a greedy bastard trade management looking for real range expansions. So this is how we look at the setups. Here, 3 different setups we are looking at. It's 6 different ones, but that's the main logic of our setups. So the major trades we're looking at, the 3-star trades, are retracement days. So for example, you have a breakdown coming out of a strong downtrend, and the next day trades inside. Then you look for a fake out high on the lower time frames to take the continuation trade with the trend. It might be also a fake out continuation into trend. This here, the example is a breakdown continuation. It's always important that all time frames are aligning with this. Next day trading inside. So these are the best examples, and I will show one of these examples in a minute. Then on the day, breakdown continuation on the same day. So it breaks down and makes a continuation during the same day. So here we have a fake out high, for example. That's the fake out example. Fake out high on the day, losing the fake out level and then trending down with the higher time frame downtrend, maybe also with a one full extension. That's also 3 or 2-star, depending on how good the time frames are aligning. And then, of course, we're also looking at reversal days. They are only 1 or 2-star. That's the classic Stacey Burke signals everyone is hunting. So that's the kind of 3 days of breakout, 3 days of long, 3 sessions of rise, reversal. We are also trading those, but we are more careful with those because you are trading counter trend. I mean, you really want to have the trend to be extended. So you're either trading the reversal on the day or a reversal continuation. So if you get a fake out high at the end of a strong up move, for example, then it's even a bit better to trade because you have already a sign of weakness. But sometimes also end week, 3 days of long, 3 sessions of rise, 8-hour fake out high might be a nice reversal trade. But you have to be aware that it's a counter trend. So looking at a specific setup example for this is the breakdown continuation with trend. So how do we identify that? We also have signal days, of course. So we are looking for a breakdown day, a day that closed in breakdown outside with the higher time frames bearish. So the next day then starts inside. So the signal day is previous day breakdown, breakdown fake out high, and breakdown fake out high on the higher time frame. And we don't want to have 3 days of shorts, obviously, once we're taking a continuation trade. So then on the day, You don't want to have previous day low triggered before you take the trade, because then you have a fake out low already. So you better have a setup that trades up. Um, Maybe print a fake out uh, high on the 8 hour in New York, maybe third hour here, fake out high. You're still inside. Once you get this fake out high and all the higher time frames are bearish, this is a very nice setup. And you can typically look at least at day low, maybe previous day low, or also one full expansion of the range of the day. So this is one of my favorite setups. This works with breakdown, but also with fake out high. It's not always that all time frames are aligning bearishly. Sometimes you can trade also against the monthly bias or against the weekly bias. It depends on the context to be judged. Once you want to be sure and want only to trade the best setups, you're really waiting for it to align. There is obviously details then on trade management. I won't go into those because it's a bit too complex. I mean, you have some variations. You might get another fake out high on the day. You have different types of entries, some more aggressive, like taking the 15-minute bar close immediately, or you wait for another lower time frame fake out high on the 1 or on the 5 minute to be sure, or very aggressively you take it once it just loses the 8 hour high, for example. You might do this once you're coming out of an existing 8 hour fake out, for example, and you're just doing the continuation trade. Stop loss typically above the high. If risk reward is not good enough, you might just put it above the 8H high or behind the last 15-minute bar. Targets, as discussed, can be low of the day, previous day low, or one full expansion, also to be judged, of course, depending on context and the quality of the overall setup. So to round this up, let's look at a specific example. This is an example of July of oil. It's absolutely textbook. You will see this in a minute. So you see here, we are trending down. We were coming out of a monthly fake out high here. The weeks breaking down, 1 week, 2 week, the third weeks of shorts actually, as we see here, the indicator flashes it, but it's beginning of the week. Let's zoom in a bit. So higher time frames bearish. Then we get on Monday a breakdown, very strong move down here, closing the day in breakdown. You see here in a weekly breakdown, monthly fake out high, and a daily breakdown. And then the day, as we've just seen on the page I just showed you, it trades up into the breakdown level of day and week, and it prints, as you see here. This is the 8 hour level, and also you see the indicator flashing here already, 8 hour fake out high. So we retested the breakdown level. This was the last 8 hour high. We traded up, closed a 15-minute bar inside. So this could be your entry signal. Once you have the entry signal, you can check with the indicator. You see here day inside and breakdown, week breakdown, month fake out high, everything bearish. The lower time frame entry signal confirmed with a 15-minute bar closed inside of the last 8 hour high. Then you just put your stop loss above the high. You take profit, in this case, one full expansion of the range until there, and then we let price move on and see what's happening. It trades down, it breaks down. You see here how the indicator works. It shows 8 hour breakdown, 4 hour breakdown. It trades down, brings the daily low down. Now we have a daily breakdown, trades even further down, all the way to the one full expansion of the daily range, hitting take profit. This would have been, in this case, an R12 with like 220 pips move. Of course, this is not a trade you get every day, but you see here how the overall logic works and what you should look for with this approach. So this would be it. I happily answer any questions you have on that. You see a lot of my trades, they're all based on this logic now, and it really helps you to stay focused and stay disciplined. And as you've seen in this example, and you will find if you trade that there are many examples like this where you're just on the right side of the trade and the trend just takes you to the other side of the daily range with a huge move, no heat, and a very high risk return typically on this trade, also with a nice hit rate. And it makes trading much more pleasurable than trying to counter trend moves all the time. So I hope this is helpful. Let me know if you have any questions on that. I will make a video on the indicator shortly showing how this works in detail and how it helps to trade this approach. Thank you for your attention.